The average household spends over $6,500 a month just to stay normal. And before most people make one real money decision, half of it is already gone. Housing took it. Transportation took it. Debt took it. Subscriptions took it. You got paid, but the paycheck was never fully yours. This is not a discipline problem. This is not a budgeting problem. This is not even an income problem. This is an architecture problem. And until you understand the architecture, every budget you write will fail before the month starts. Here is what is actually happening. In 2024, U.S. households spent an average of $78,535 a year. That is $6,545 every single month. Just to stay normal, not to invest, not to save, not to build anything, just to maintain the current version of the life they already have. And inside that $6,500, two categories alone consumed over 50%. Housing averaged $26,266 per year. Transportation averaged $13,318 per year. Together, before groceries, before investing, before any choice, those two categories consumed more than half of the average household's income. Let that land. Half. Before a single decision. And transportation is where the story gets more expensive. The average new vehicle payment in the United States reached $767 a month in the fourth quarter of 2025. Not a supercar, not a luxury brand, the average new vehicle. Now here is what most people never calculate. If that same $767 were invested every month at a historical assumed annual return of 8%, over 10 years it would grow to roughly $140,000. That is the number that was agreed to, not $767, $140,000. The car payment is not the problem. The lost capital is. Now here is why fixing small spending fails. Most people who feel financially stuck try to fix layer 4. They cut the coffee. They cancel one streaming service. They track every small purchase. And they feel disciplined. Then the month resets and nothing changed. Because layers 1 and 2 already took over 50% before layer 4 ever existed. There are 4 layers to every paycheck. Layer 1, fixed costs. Rent or mortgage, car payment, insurance premiums, minimum debt payments. These were decided once. Now they run automatically every month forever. Layer 2, semi-fixed costs. Phone plan, streaming services, gym memberships, software subscriptions. These feel flexible but almost never get canceled. Layer 3, committed spending. Groceries, fuel, basic household supplies. Necessary, and usually larger than people track. Layer 4, lifestyle and discretionary. Deliveries, dining, clothing, entertainment. This is the layer every budgeting advice video targets, but it is the smallest layer. The real battle is in layer 1. The real intervention is not discipline, it is redesigning the architecture. Here is the exit. Step 1, audit your pre-committed income. Add every automatic or unavoidable payment that leaves your account before you make a decision. If that number exceeds 55% of your take-home pay, your wealth system is structurally broken. Not behaviorally broken, structurally broken. Step 2, identify your highest leverage fixed cost. For most people, that is transportation. For others, it is housing. A $200 per month reduction in any fixed cost, invested instead at 8% annually, grows to roughly $36,000 over 10 years. Not from earning more, from claiming back what was already yours. Step 3. Before agreeing to any new fixed cost, calculate the 10-year opportunity cost. Not the monthly payment, the opportunity cost. Because a $767 monthly payment is not $767. It is $140,000. Your paycheck arrives every month, but the architecture around your life has already decided what it builds. Right now, for most people, it builds the landlord's portfolio. It builds the bank's income. It builds the subscription company's growth. The question is when it starts building yours. WealthFrame. Invest smarter. Grow faster.